Good afternoon, everyone. Thanks for joining us. I'm Joanne Kingsnorth. I'm Joint Managing Director at Seymour Taylor, and I'm delighted to have you with us today for this webinar on business funding with Sharon Cook, who's joining me. As a bit of an introduction, I just wanted to set the scene for you. I mean, obviously, we have had 2 years of the pandemic. We've had bounce back loans, we've had CBILS, we've just had the recovery loan scheme ending yesterday. And we've got an economy in a bit of a crisis, it's fair to say. We've got the cost of living, we've got inflation at north of 9%. We've got wage pressures from employees coming from all directions. And I think never has it been more topical to discuss business funding. We've had a lot of clients contact us and ask about putting their business in as good a picture as it can possibly be to get successful funding, and making sure that any application made has as good a chance of being successful as possible when it's put in front of the funders. So I'm delighted to welcome Sharon Cook, Director at Choice Business Loans, who's got a wealth of experience in this area. I've known Sharon for a good couple of years now, and I'm delighted with the way she talks to my clients and is really helpful to my clients. So I'm looking forward to what she has to say. If you've got any questions and answers, please do feel free to put them in the chat box or the questions and answers box, and we'll come to those at the end. But with no further ado, I'll pass over to Sharon, and let's look forward to hearing what you have to say, Sharon.
Well, thank you very much for that very kind intro there, Jo. It's really good to be here. So I'm Sharon Cook, Director at Choice Business Loans, and quite rightly, we've just come off the back of a huge couple of years working with various clients to help secure the CBILS loans, advising about the bounce backs loans and the recovery loan scheme. And I can tell you with the CBILS loans, we helped raise in excess of £20 million. We haven't done the adding up on the recovery loan scheme, but I think we are still we're still recovering from that crazy time. But now is the time where we're finding lots of clients are looking to grow. Pandemics do not stop growth. They do not stop businesses wanting to acquire. They do not allow businesses to just get over a pandemic where they've got a hole in their cash flow. So today we're going to cover just a few basic topics of getting ready for funding. We're going to talk about limiting factors, and that's what the big problem with some of the funding requirements that people have is they have limiting factors in their business, and we'll cover those. We'll briefly cover types of funding because I could literally keep you here all week and I wouldn't want to do that for you. We're going to look at cost of funding very, very briefly and just touch on the RLS Mark 2 or 3. Don't know which one it is anymore. Mark 2 for the RLS, Mark 3 for the government loans. So let's have a chat about getting ready for funding. Okay, fabulous. So getting ready for funding. So before you embark on the funding journey, there are a few important and very basic checks that you really should do first as a business and as directors. By doing these, you'll be able to determine which lenders could and would consider your application more favourably, and it allows you to make changes in advance. So with credit is one of the big things. Directors' credit is really important. When a funder is lending to your business, they're also lending to you as a director. So making sure that all of the directors' credit scores are in order and there's nothing obvious on your credit files. The same goes for your business credit file as well. And we have major credit files. We have Equifax, we have CreditSafe, Experian, and some others that we have out there, and they all share data. But what they don't do is they don't share data in the same way. So a lender might use one credit house rather than another. And on that credit house, they might have taken your information in incorrectly. So it's important to check that the information on your credit files, personally and business credit files, are really important. And if anybody here does want us to check your credit file for your business only, can't do your personal file, do get in touch and we'll happily help you do that. So one for Jo here is where you're looking at your accounts. And I know as business owners, we really are running this business to take money out. We're doing it because we want to pay ourselves. It's really important that you leave some money in the business on your balance sheet and making it look healthy and not just taking everything out. So it's important to make sure that you're preparing your business well in advance of going for funding, especially for larger amounts. You need to make sure you have an up-to-date P&L, profit and loss, and a balance sheet, and it all prepared it's a bit different now because we'll have zero, or we have the stage and everything, and we can press a button, but they need to be correct and they need to be in order. And more importantly, you need to understand what they say. Being up to date with HMRC is also very important when getting ready for funding. It's not always easy, and time to pays are a really good thing to use because they're free. They are interest free. Being into a time to pay is not a problem, but being upfront with the lender that you're in a time to pay is important, and making sure that the affordability of the time to pay and of the loan is there for, and can be achieved by the business. Now, talking about affordability, we do get a lot of people ask us for a large sum of money, and it just isn't affordable. They haven't done the maths on it, and it's important to make sure you know exactly what your monthly repayments will roughly be, and can you afford those coming out of your cash flow every single month for the term of the loan. Very important. One thing that's overlooked a little bit is bank statements. Business bank statements need to be clean. No direct debit bounces, no missed payments, nothing. And you shouldn't be at the very, very bottom end of your overdraft either, because there's no room. If you're at the bottom end all the time, then there's no room for another payment to come out. So it's important to make sure that you have good quality, clean bank statements, and they're going to check those. And the last thing really is, have you sense checked the requirement that you're looking for? It sounds obvious, but under capitalization is as bad as over capitalization. And will it deliver the return? So the cost of the lending that you're going to be taking, will it deliver the return that you're looking for? So that's important to look at. Okay, so just a quick recap. So for anyone that wants to look at it, this can all be sent out there. So looking at credit, looking at your accounts, making sure everything's up to date, affordability. Do you need a cash flow forecast? Is it that kind of lender? And are your bank statements clean? So the next slide, please, Suzanne, if we can. So limiting factors. This sounds a bit strange when I talk to people about limiting factors, but it's what I look for when I'm talking to a business and talking to them about their requirements. And this will absolutely determine what lenders we can go to, because my life would be so simple if every single lender had the same appetite, had the same thing to go for, but they really don't. Every lender has a different nuance, and it's my job to know what they are. But it's important that you understand that these are out there. And you will get declines. I was speaking to a very wonderful, successful lady this morning on the phone who's growing her business, but she didn't understand why she couldn't get an RLS. She just went to the wrong lenders. That was the problem. She went to lenders that needed something different than she was showing. And the growth of her business was growing so strong that the profits were probably less than they wanted. So, really knowing these things can help. So the big one is home ownership. Now, I'm not asking about security here. I'm saying that some funders and some funding lines absolutely require the directors to be homeowners for no other reason other than that is their requirement. And potentially with having a personal guarantee, knowing that there's something in the background there, and knowing that homeowners have to pay a mortgage. So it's something that they do, and they do some of insist on that. In some cases, they'll lend to tenants, but only to a certain level. And that's it. It just cuts off at maybe 50 grand, something like that. And anything above that, they might need a home ownership. And others just won't talk to tenants. So that is one factor. Credit scores. We talked about them earlier. Company and directors' credit scores. And they have minimum levels. Sometimes they'll have a minimum level on something like Experian. And that's called they call it the Delphi score. And if your Delphi score is 40 or under, they won't touch you. It's an immediate decline. So knowing those scores and across the different credit files is quite important. Company turnover. Sounds probably a bit vague, but how big is your company turnover? Some lenders will lend to a percentage of company turnover subject to affordability. They would even go up to a maximum of 60% of turnover. You may be used to the bounce back loan and the CBILS and the RLS looking at 25% of turnover. And frankly, I think 25% of turnover is a reasonable level for what you're looking at. but some will lend higher, is subject to the affordability. The other thing that they look at is your numbers of years trading. Anything under 2 years, and maybe even now 3 years, is considered high risk. So if you are a young company, you're either going to be paying high for the money that you're borrowing, or you're not going to be able to borrow the money that you're looking for, and you may have to look at different ways of doing that. Your directors' business histories are important too. I had to put my teeth in for that. Hard to say. We deal with we're human, we have mistakes, things happen, businesses fail, and we restart them, and they fail for many reasons. Some of those reasons could quite simply be, a really large company went under and left you with a massive bill of 50,000, £60,000, and it was just 10 grand too much, and you had to put your company under. But all these things absolutely will come back to haunt you, and being upfront about them with stories ready are really important. The other thing is, and we touched on it earlier, is balance sheet levels. Weak balance sheets can lead to a quick auto decline, especially for those lenders that use algorithms. So it's important to make sure that your balance sheet is as strong as possible. And one slightly odd one, and I put this in here, and the last one is the SIC code. The SIC code is what you have put on Companies House when you have registered your business, probably a number of years ago. And it could be that your business has slightly changed. So the SIC code that's on there may not be relevant to the business that you're doing today. So make sure that they match what you're doing. And some SIC codes will be an auto decline. We find it very much in the construction sector. A construction type SIC code can be a decline for some lenders. So quick summary there on on limiting factors. Just let you have a little look at that. If we go to the next slide then, please, Suzanne. So searching for funding, this is the hardest thing I think that we do. So I think a couple of things here is understanding the funding type that you actually need. Do you need a loan? Do you need a block of money popped in your business that you're going to use relatively quickly, that's going to have you a very quick return on that investment that you will then repay back over a period of time? So that's one question to ask yourself. Do you need a consistent turnover of cash flow? What is your actual requirement? Because actually a loan won't give you a consistent turnover of cash flow. So you may need to think of other avenues for doing that. And that could be something like asset finance or invoice finance, not asset finance, invoice finance, revolving credit facility. We'll touch on them later. Are you happy providing a personal guarantee, director's guarantee, and putting a little bit of you on the line, or a debenture over the business, or something secured by property? You could get it cheaper. So it's quite important that we consider those things when we're searching for funding. And I think I would always say the first point of call, once you've decided what you kind of prepared to put on the line, prepared to do, and what you may need, is check with your own bank. I think you should always go to your own bank. And I know probably eyes are rolling in the background. Yeah, but I can't speak to them. I can't do this. I can't do that. They are the cheapest form of finance. And I would always say, go there first and see what you can do. If they say no, then it's a different conversation. But what type of loans are out there? So just a loan that goes into your business that you use and can just go, probably based on a personal guarantee. There's asset finance. So if you're buying a truck or a piece of machinery or a fleet of cars or a couple of cars, doesn't really matter. The security is the asset, and you can get really good rates on that, and sometimes have it without personal guarantees as well, because the asset is there. Even soft assets can be financed. If you need a constant cash flow, invoice finance might be the answer for you. And invoice finance, I know people think it's a distressed product. It no longer is a distressed product. We're being forced into paying longer and longer, having longer and longer payment terms. You as a business owner are not a bank. So when someone's asking for 60, 90 days credit, that's now hurting you. So you may have to put something in place. But with invoice finance, it's changed. There's a whole book, so you just put all your invoices through and it's done. And once that's done, you know, you can just keep going. You might just have one big client that you work with, like Waitrose or Sainsbury's, and you might just want to invoice finance those, as an example. Or you may have a small cluster of people that you want to invoice finance, or just one invoice that you think, the biggest invoice I've ever done, I could do with that money up front. So it's a lot more variable nowadays. We have, oh, thank you, Suzanne. Yeah, probably need to next one on. Thanks. We have revolving credit facilities, and revolving credit facilities act very much like an overdraft. They sit in the background and you draw down on them, you pay an interest only, and then you repay it back and stop paying interest. So it's really handy, especially if you've got an invoice finance line with your bank and your bank have removed your overdraft facility. It's a handy thing to have. And we have different and varying sizes of these revolving credit facilities, from 10 grand to £5 million. So they are really interesting. We have e-commerce financing. So if you're an online retailer or B2C as well, financing, we have a raft of specialists in the marketplace, absolute raft of them, all coming in, especially for online trading, which is becoming so big now. And retail financing is where we look at. Retail is hard to finance, especially with loans, but they will advance sales against your credit card terminal sales amounts, and they will do 2 or 3 months, so you can get monies in. So if you're hospitality, or if you're high street, that's a really good way of getting money into your business fairly fast. And of course, we have VAT and HMRC funding. Sometimes these bills are massive, and they can really hurt your business, especially if you had to dip in to your savings pot where you're saving for that. We have lenders that will say, we'll help you effectively put it on direct debit and help you move forward. So there's plenty of different options out there that can match your requirements. There is a lot more, and I promise I won't talk too much on this. But either way, you have to understand, out of all these, what lenders are going to be the best lenders for you. Are they algorithm-led lenders? And do you have to pass that algorithm just to get your money? Or do you need to talk to a human being? And all these lenders will have algorithms and human beings where we can talk to and have conversations. It all depends on where your business is at your time. So thanks, Suzanne. Do you want to go to the next slide? The new RLS scheme, and there is one, but we don't know what it looks like yet, which is very unhelpful. We think it's going to be launched at the beginning of next month, so we're July now, so August, and we think it's going to be fairly similar to what we've just seen, not too much difference. We think it's going to come potentially with personal guarantees, or partial personal guarantees / directors guarantees, or debentures. I think that would be lender-led on that. And we also think that the lenders will have smaller amounts of money that they can lend under the new scheme. So it's not going to be quite as large, but it's going to be out there for those that need it. So it's worthwhile keeping that in mind. And obviously I'll let Jo know as soon as I know when something comes out, and go from there. You good to go to the next slide there, Suzanne? Probably the next one over again. So I'm going to finish on this for you. Headline rates. And it's the one thing that is my bugbear. And it's the one thing that if I could lobby for anything in our industry to change, it would be this. And it would be the transparency of rates. I don't talk about rates to my customers. I talk about pounds and pence, because that is understandable. So if we were to borrow £50,000, would you rather pay 10% or 8%? Now, for those that know, will know the answer. But for those that don't know, probably be more swayed by the 8%. But Suzanne, if you could go to the next one. So this is the reality of cost on those. So a loan over 2 years at 10% APR will cost you £5,373. A flat rate cost you 8. And over 5 years, you see now the difference within that. Huge, huge. So regardless of what you do, regardless who you talk to or how you go to get your money, at the end of the day, before you sign anything at all, you need to understand monthly repayments. How much is it going to cost my business on a monthly basis? How much is it going to cost my business over the period of time? And then you can decide if that suits your business and that suits your pocket. Because if it does, then great, carry on. It doesn't matter which one of those they are. And if you can afford to repay it and you're happy with it, that's absolutely fine. But you need to know as a business owner exactly what you're repaying interest-wise, as well as you repay the capital too. And that's what's going to make the difference. So ignore rate, ask about pounds and pence would be my last and final bit of advice there. So Suzanne, I think we get to go to Q&A.
We've just had somebody that's asked whether the presentation is available afterwards, which it is. We will have a recording of it, which you can make available. We did have a question prior to the session, which was, what happens if I am nervous about signing a personal guarantee?
Yeah, personal guarantees are something that pre-pandemic we all signed without thinking about. And then when all the loans came out without personal guarantees, I think it's highlighted that you're signing a personal guarantee, if that makes sense. And so I'm finding now a lot of my clients would rather not sign a personal guarantee, but the truth of the matter is that eventually going down the line, it's all going to come back to personal guarantees. Directors' guarantees will need to be signed regardless. So 2 things, you need to be really sure that you are going to pay this money back and that the money that you take is going to have the effect on the business positively that you need it to. And there is something out there called personal guarantee insurance. There's only one provider to my knowledge, and it's a proper regulated insurance product. It's, I believe it's tax effective there, Joe, you'll understand that, but it's a business expense, so it's not cheap, is all I'll say. But in my opinion, you wouldn't take it for the whole period of the loan. You'd probably end up taking it for the expensive part. So where you have a lot of the capital still outstanding, you would pay for that. And then when you get down to the smaller end of the scale, you could probably make an informed decision not to pay it anymore, because the business would be able to cover it if it all went wrong. And bearing in mind, a personal guarantee is only called on when you don't pay, and when your business probably is no longer viable as a business and needs to go through the process. So I hope that answers that question.
Thank you, Sharon. Yeah, just to reiterate, somebody else has just joined. Yes, we will be having a recording available, which we'll email out to you afterwards. There isn't any other questions in the Q&A, Sharon.
Just ask a quick question, Sharon. Do we have any indication yet as to when the new RLS information will be out? Are we expecting it imminently, or will it take a few weeks?
I think it's going to be a couple of weeks, Joanne. I think they need to get all the monies paid out, because a slight strange nuance was everything had to be credit approved yesterday, and then they can do the payout process and lodge all that with the British Business Bank. I think once that's been done, and it's all together, I think the British Business Bank are going to hopefully let us know mid to end of July. But I do know that we already have lenders signed up to the new scheme, but I think they've just been sworn to a bit of secrecy on that. The British Business Bank want to do a bit of a hurrah. I think it'd be more like a damp squid than a hurrah, but there we go. We'll let them have their moment.
Great, thank you. Well, thank you. That was really great. I think a lot of good information there, a lot of good thoughts and things to take away. I think for me, the biggest takeaway was actually it's really important to understand what you need and what sort of financing is the best for you. So yeah, absolutely worth listening to. I hope everyone will agree. And I think with no further questions, I think we'll end it there. But thanks ever so much, Sharon. Really appreciate all your time.
You're welcome. And I'd invite anyone to reach out and have a chat with me or my team if you've got any questions, because it's such a big subject. We just can't cover it all. I'd bore you to death. So
No such thing, no such thing. But thank you, everyone. Thank you, Sharon. Really appreciate
thank you.
it.
See you.
Have a
Bye,
nice
everyone.
afternoon. Thank you. Bye-bye.
Bye.